Let's take a look at the COWZ ETF, formerly named the Pacer US Cash COWZ 100 ETF. The name itself gives us some clues into what this ETF actually does and holds. Cash COWZ indicating that it's going to hold stocks that have high cash flow, and 100 being, well, the number of holdings that it has. We can see the fund summary right here in the fact sheet from Pacer. It reads, a strategy-driven exchange-traded fund that aims to provide capital appreciation over time, isn't that the point of all equity investing, by screening the Russell 1000 for the top 100 companies based on free cash flow yield. So the Russell 1000 is our universe, the top 100 companies based on free cash flow yield. And we can see where they've got the definition of everything that, is used to make up this free cash flow yield. So free cash flow, a company's cash flow from operations minus capital expenditures. Ultimately, how much cash do they have to work with at the end of the day, right? Like how much cash do they have to distribute? Either acquire a company, pay back the shareholders, buy back their company's stock, pay down debt. Those are really the four things that companies can do with their cash. So I guess I'll just kind of reiterate that. A company can either distribute money to its shareholders, it can buy back its own stock, which is fundamentally the same thing as, has the same effect on shareholder equity. It can pay down its debt. That also has the same effect on shareholder equity. And then a fourth thing, you usually don't hear this. I hear a lot of people talk about the three things companies can do. There is a fourth thing. They can acquire other companies. They can make acquisitions. That would not fall under, that would not subtract from free cash flow. Under generally accepted accounting principles, there are some metrics out there where that is subtracted out here, but that is not expressed in this. It does say in long-term investments. I'm going to think, and to my knowledge, based on some other documentation I've read, it is not explicitly stated, but it is implied that they are not including acquisitions in this subtraction. Long-term investments would be like buying new property, plant, and equipment. So a company can do those four things, which I've gone off on another tangent there. They can distribute money to shareholders, they can pay down debt, they can buy back their own stock, or they can make acquisitions with it. Right? So companies that have high free cash flow can do those four things. Enterprise value, all right, in the formula, that's a company's market capitalization adjusted to eliminate any capital structure bias by adding debt and subtracting cash or cash equivalents. And then free cash flow yield is going to be the free cash flow divided by the enterprise value, all right? So how much cash flow is this generating? Free cash flow is this company generating relative to their enterprise value, so they can pay down debt, distribute money to shareholders, buy back stock, or take advantage of acquisitions. So that is what the free cash flow yield is, and this ETF, the US Cash COWZ 100 ETF, invests in, from the Russell 1000, the 100 highest free cash flow yielding companies. We can see in this document right here that explains their methodology. It's fairly simple methodology with the fact that I think there might be some errors or undisclosed information in here. We can see the Russell 1000 index. They do their free cash flow yield screen to get the 100 companies by free cash flow yield. And then there's another step, highest trailing 12-month free cash flow. That's kind of where things, I guess they're not explicitly saying what this is, right? So you can see that they apply the screen to identify the high free cash flow yield companies right here. And then, what happens after that, right? Highest trailing 12-month free cash flow. So I'm guessing they're going to, weight these according to the companies that are spitting off the most total free cash flow. And we can see the free cash flow yield as it goes through the screens, right? The Russell 1000 free cash flow yield 2.93%. When they apply their screen and identify the top 100 free cash flow yielding companies, the free cash flow yield of those companies, I'm guessing on an average basis, I don't see anything in here about weighted at this point, is 8.77. Then what they do here is they're weighting them, weighted by free cash flow, highest trailing 12 month. When they apply their weighting methodology, it takes the free cash flow yield of that portfolio up to 9.78%. So it adds another layer on top of it. It says the holdings are capped at 2% for each company at time of rebalance. And I did look at the holdings. I guess we'll look at the holdings maybe in a second. But what you'll see is that the holdings can be very small, and some of them up to 2% or larger, and then reconstituted and rebalanced quarterly. So they're, this methodology right here is pretty clear, but there is some I don't want to say secret, but I guess it is secret because we don't know and I cannot find any disclosure of it, methodology and how they're actually weighting these and what kind of tilt. They're certainly giving a tilt to companies that spit off the most total free cash flow. That's, going to be tilting towards the largest companies, but not giving us exact data published on this. So this is the methodology. Let's just take a look at it and see how the strategy is done. Actually, before we go to that, there are actually other strategies that do this by Pacer, other ETFs that implement this strategy. This one here is the US Cash Cows. I think they call it 100, and it's looking at 100 from 1,000 companies in the Russell 1000. But we can come back to Pacer's website here and go to their series lineup. They apply this methodology on other markets as well. So we got small cap cash cows where it looks at the 100, the top 100 from the small cap 600. US cash cows growth. I did not open up to see what that one is. Global cash cows dividend, developed markets, international cash cows, and then emerging markets cash cows. So it'll be interesting when we look at the backtest, or not the backtest, but when we look at these on Morningstar, I will open up the international one as well. I don't know what the methodology is here and why they say dividend, so I'm not going to research that one right now. And then, of course, they've got the fund of fun, the Pacer cash cows. Here, we're just going to put you into all these ones, and you get a diverse portfolio, and we're going to tack a little bit more on top of it. And while we're looking at this basic data kind of information here, let's just cover some of the basics on cows. I didn't do this right off the get-go. I usually do this right in the beginning. But interesting to point out, it has a 5-star Morningstar rating. And it's very, very rare that you see a niche ETF like this or a factor ETF with a 5-star rating from Morningstar. I don't know how or why COWZ is up there. Overall rating out of 1,147 large value funds. Yeah, based on risk-adjusted returns of large value funds. So this thing does have a bit of a value bias to it, but I wouldn't call it a value fund, but that's what category Morningstar wraps it into. So I guess what I'm saying is that niche and factor funds don't do well on risk-adjusted basis in their Morningstar category. Anyways, whole nother topic. I could do a whole video on that. Assets under management, net assets, $2.2 billion. So fair assets under management, actually pretty good. You don't have any reason to worry about liquidity issues or, like what you'd have with thinly traded ETFs. When you're getting into niche ETFs or factor ETFs, you do want to make sure that you're not investing in something with, very low AUM, or if you do, you have to control and use limit orders to control the amount not the amount in frequency, but the amount when you buy in. And if you're placing a large order for $1 million into a fund that only has $10 million in it, you're increasing AUM by 10%, you'd probably want to space that out. Anyways, again, not the topic of this video here. I'm good at going off topic. And then the total expenses, 0.49%. So it's not low like an S&P 500 index tracker. It's also not totally far-fetched. I'd say it's just kind of right there, smack dab in the middle of what you'd expect for a niche ETF. So let's go on and look at the backtest for this here. Backtests, they always look great. No exception to the Pacer US Cash Cows 100 index. We can see the green line going back to January 192, just absolutely rip-roaring and pissing on everything else here. Yellow line being the Russell 1000, and on a total return basis over this, 18-year time period or 19-year time period? It's more than 5x'd it on a total return. Like, that is fucking huge. But again, you never see a bad backtest. So it's always important to consider what these things look like out of sample. And I recently did a video, I'll put a link to it below, basically where I took a document that showed a bunch of backtests, and it was published in 2015 on a bunch of factor investing strategies by S&P. This was in 2015 before they launched a lot of funds to reflect these strategies, and the backtests look good. And then I looked at the performance going forward since they launched the ETFs, and they're all basically failing or not really doing much of anything. They're mostly all underperforming the market. Some are outperforming the S&P by a little bit, but not much. But in aggregate, they're underperforming it. So out of sample data is really crucial to look at, and so often we see backtests that look great, and then going forward out of sample they don't do so well. Truthfully, I can't say that I know of one backtest or one factor ETF strategy that I've seen and said, wow, that looks good, at the backtest. and then seen it launched and 5 years later say, wow, that still looks good. At most they're just kind of keeping up with the market. At worst, some of them are really lagging it. So we'll take a look at it and see how this performed here. So let's just kind of go back to the fundamental strategy of this, right? What are the pros and cons of this strategy? Like, what companies does it capture? What companies does it miss, right? It's obviously capturing companies that have a high free cash flow yield. So these companies are spitting off a lot of cash flow. What does that capture? Well, it's capturing the companies. No way of saying this. It's capturing the companies that spit off a lot of cash flow. But what is it missing? I guess I'll take that approach. It's easy for me to say that. It's missing companies that have high research and development budgets. Okay, so there could be a company out there has a really high profit margin, or a real high operating margin, I think would be more appropriate to say. There could be a company out there that has a really high operating margin. It's growing, like it is churning cash, but the company is reinvesting it back into research and development because that is an expense. Okay, so it's not going to capture those companies. A company like, I don't know, I was going to say Pfizer, Johnson & Johnson. Might be another one, I'm not really sure, but both of those companies probably have pretty high R&D budgets. They probably generate a lot of cash, but they also spend a lot of money on research and development. So they probably generate a lot of cash at an operating profit kind of level, but then they do spend quite a bit of money on R&D. Right, so it's not capturing those companies that are developing and innovating. It's not capturing the growth companies that have proprietary products and are capturing market share, like Tesla. Tesla would absolutely not fit into this. And then what is it going to capture? Well, it's going to capture companies that have that free cash flow to reinvest and make acquisitions. I really stressed that early on in here because acquisitions are not going to subtract from their free cash flow. So the company can generate free cash flow, keep the money on their books, then make an acquisition, right? And I mean, that's a fair case for growth. There's nothing inherently wrong with that. I do think that by and large, acquisitions tend to be good for growth. I like the concept of acquisitions, particularly at a small business level. That's where I've made my bread and butter, is by acquiring small businesses, specifically home service businesses. Anyways, this video is not going to be about me and home service businesses. Anyways, yes, companies with the free cash flow can acquire other companies. That's not going to subtract from this. The other thing too, where it might throw some curveballs into the whole system, is companies that are getting high tax credits or taking big tax deductions. Taxes could really throw a loop into this whole system because there are some companies out there that can do weird things with taxes. And then that'll really, really boost their cash flow. Or, 1 year they might have a really strong cash flow because they, get a bunch of tax credits from something. And boom, suddenly they get caught up in this screen here. So the strategy could ultimately end up getting that. So you're missing out on the high growth companies. You're going to catch companies that have money for acquisition, which would probably be good. Those would be, I like that concept. We'll come back to that. And you're also going to catch companies that have, in some way, maybe taking advantage of the tax code. I think the real big opportunity here is catching companies that are acquiring others, right? If you can get the companies that are acquiring others and not just distributing their money, to shareholders by either distributing the money straight up as a dividend, paying down debt, or buying back their own stock. All three of those have the same effect on shareholder equity. If you can get companies that are acquiring others and acquiring growth, you can get more value, I think, out of the stocks. And I think that is, if we were to do like some, regression analysis on this, you could probably show that a lot of the returns of this strategy come from companies that are making acquisitions. Because the other type of company you have would be a company like Verizon, where they just churn cash out, or they don't buy cash, they don't churn it. That's a poor way of expressing it. They generate a lot of cash, but they just distribute it. And they distribute their cash, but their stock just stays pretty even, right? So there's no appreciation there in the actual equity value. They're just distributing their cash. So yeah, I think this company, or this strategy, catching companies that are on a real acquisition path or are pursuing acquisitions is really a value-added premium. Then there's also the value component. I didn't really touch on this, but we can see the price to earnings ratio here of the Russell 1000 is 27.89. What date is this based on? Based on December 2021, so pretty current. PE ratio 27.89. You apply the cash flow yield screen 13.04, and then you apply their weighting methodology to it. Then the PE ratio of the whole portfolio becomes 10.13. So you're in a sense getting these companies at a value. It's certainly buying earnings. When you invest in these companies, you're getting earnings at a lower rate than if you invested in the Russell 1000. So there's a little bit of value here at play, but it doesn't really behave like a value fund. All right, so we've seen the backtest. Let's go on and look at this thing and just see how it's performed out of sample here. We'll start with a chart against the S&P 500. That's kind of always my baseline for doing anything, is just open up an S&P 500 chart here in Vanguard. This is going to show us the total return of a $10,000 investment based on the starting date that we choose. Now, Pacer's COWZ ETF, I think, was launched in 2016 towards the end. So really the effective start of it, or not the effective start, but the start we're going to use is probably January 2017. Inception date, yeah, 12/16/16. So we'll put this thing on here, and we will go back to 2016, 12/31. There's S&P 500 returning 108.03% on a total return basis since that date. We'll put COWZ, the ticker symbol for COWS, on there. I think I clicked the wrong thing. Yeah, we don't. What I click? I click the index. That doesn't show on mine. There we go. So there's the ETF. And holy shit, look at the numbers. Look at the numbers. S&P 500, 108.03%. COWS, 108.87%. Basically about the fucking same. We can see that COWS lagged the S&P 500 for a while, and then in the post-COVID bump, it caught up, and then in a little bit of a 2022 dip that we've had for the first 6 or 7 weeks of 2022, the S&P 500 has been in a really nice drawdown, and COWS has kind of caught up, and the S&P 500 has just converged downward towards COWS, so they're about the fucking same. But you know what I need to point out here is, let's go back to that backtest. All right, that backtest looked great. I mean, that 16.83% annual return, just smoking the Russell 1000. But here, I guess I could put the Russell 1000 on there. It's barely outperforming the S&P 500, but where does it really want to smoke that Russell 1000? I'll put the Russell 1000 on there because I know if I don't, somebody will leave in the comments, oh, you got to compare it to the Russell 1000. We'll put the Russell 1000 ETF on there. No, Russell 1000 ETF has basically done the S&P 500. So yeah, we can see it right there. So out of sample, since it was launched, the strategy has not outperformed the S&P 500, or, well, I guess it has technically outperformed the S&P 500 and the Russell 1000, but by an absolute meaningless number. I would say an immaterial number. Let's go back here, because Pacer has some other ETFs. I said we would look at the ICOW, International Cash Cows 100. Let's just plop that onto the chart as well. We'll put ICOW on there. There it is. Okay. So ICOW didn't launch until, can't tell what that date is, but I'll set that to 7/1/2017 or 6/30/2017. Which will be 7/1. It's using end-of-day data, so this is effectively 7/1. All right, so obviously international equities have not done nearly as well as U.S. equities in this time period. There it is. It's returned 40.79%. Let's just put EFA on there. Use the iShares EFA Index ETF. And boom. ICOW, basically doing about the same, although we can see, towards the end, it is kind of pulling away and outperforming a little bit. So iCal returning 40.79, EFA 30.07. Let's just set this year to date, because one of the things I think that's kind of interesting to look at with a strategy or to consider is that these companies are going to be fairly high quality companies. If they're producing that cash flow, that strong of a cash flow yield, they're producing profit. They're higher quality companies than a company that's losing money and just kind of operating on new investments and debt. So let's just set this to 2 time periods here. First, we'll look at COVID, and then we'll just see the recent month. So I will just come in here and go 2020 March 1st, 2020. I guess we'll just go to the October 2020. About when did the S&P 500 do its thing? It looks like the S&P 500 pretty much recovered by July. Oh, how fast time flies. It's barely 2 years, not quite 2 years. We forget what's happened. COWZ, all right, so COWZ had more of a drawdown than the S&P 500 did over this time, and it kind of spiked back up really quickly. And then iCal being the green line, EFA being the blue line. EFA did better. So yeah, it's kind of weird. I was expecting to see less drawdown from the cash COWZ ETFs. Let's go on to look at year-to-date 2022. So year-to-date 2022, this looks interesting here. COWZ being the red line has less than 1% drawdown, whereas S&P 500 down 9.5% year-to-date. So it's showing to be fairly resilient right now. And iCal up, while international equities, international developed equities, EFA, is down 5.57%. So, possibly this is just the diversification, or I don't want to say possibly diversification value, but it's not just the diversification value. I shouldn't say that, but it highlights the diversification value from market cap weighting, whereas market cap weighting equities are going down. These companies that are consistently producing profit are going to be a little bit more resilient. Obviously, COVID throws us a curveball. No one really knew what was going on with that. We still don't even know what really happened during COVID, and the economics behind it all. But in more of a traditional economic climate, these cash cow type of companies are going to be a little bit more resilient. So that's kind of cool to see this playing out here. One other thing I think that's interesting we should talk about before I sign off on this one is shareholder yield ETF. That is by Cambria Asset Management or Cambria Wealth Management. Meb Faber is the persona behind that firm. And shareholder yield basically uses a strategy that identifies companies that have the highest net buybacks, net dividends, and net buybacks, net dividend, and net debt pay down. Or maybe it's not buybacks, but net shares issued, right? So net shares, yeah, that's it. Net dividends, net shares issued, net buybacks, right? So it's identifying companies that are highly doing that stuff, right? So it's not totally dividends because it's including companies that are buying back their own shares and paying down their debt. Similar kind of strategy here because, as I expressed, there's 4 things companies can do with their money that's not expensed, and there's only one other thing, and that's acquisitions. So it's going to be very similar to this cash cows. Let me just open this up here and put this on here. That doesn't look right. What did I select? I was going to say, I was looking for something a little bit more volatile than that yellow line. Canadian market has a SYLD ticker symbol. Yeah. So SYLD performing similarly to COWZ during this time period. I'm expecting that over a longer time period it does. Let's get some of these other things off of here. There we go. So yeah, green line being the shareholder yield by Cambria, red line being the COWZ ETF. It performs very similarly. A little different. There's some differences there, but I think long term you'd expect the strategies to have about the same long-term total return. So finally, before we wind it down, how should you fit this into your portfolio? Well, first thing, I guess I should throw out the disclaimer that I am not your financial advisor. I am not a financial advisor. So take anything I say, as just a part of your research. Do your own due diligence. Make sure you understand everything and come to your own investment decisions, and do not consider this financial advice. Now that we've got the disclaimer out of the way, personally, for these niche and factor type of ETFs, I keep them a very small percentage of my portfolio, and I really only stick to one or two, because it's like, number one, it's very hard to stay invested in something when the market is doing something different, particularly when you're underperforming the market, right? So if you're holding COWZ and you're right here and the S&P 500 is, up 61% and you're only up 21%, that kind of hurts, right? That hurts a little bit. So it's much easier to stay convicted when you're holding the market. That's number one. Number two, it's it's just more statistically likely that the market will outperform. And then number three, when you're holding all of these little factor and quantitative investing and niche strategies like this, ultimately what you're doing, number one, is you're diversifying yourself away from the market beta, which is more likely to outperform all of them. Statistically, that's how it's been historically. You're getting away from that, but then you get all these little factor things going on. Your portfolio just kind of becomes a mess. And when you look at the returns of all of them, it's combined, your total portfolio return, you find out that, well, one may have done well, the rest didn't, so you're still at a lower return than the market cap weighted index. So yeah, I'm a huge proponent of market cap weighted indexes. And personally, a lot of people are like, well, what do you invest in? Market cap weighted index with quantitative momentum and trend, and leverage is my thing here. So when I look at these niche or factor ETFs, yes, I do hold some of them, but I keep them a very small percentage of my portfolio, and I have just, a very small, I don't want to say handful, but like two of them that represent two factors that I'm very convicted to, and I leave it at that. So bottom line, I would suggest keeping market cap weighting a large percentage of your portfolio. Consider this a little bit of a, invest in this to get a tilt, but just pick one factor or one niche, whether that's momentum, value, COWZ, which is high cash flow generating with a value tilt, so to say, would be in a Morningstar value category ETF. Pick something you're highly convicted to, use that for your diversification to market cap weighting, but keep it small and constrained. So guys, on that final note, what do you think about the COWZ ETF here? Are there any details that I missed? Let me know in the comments below. I'm signing off on this one.